You know that feeling when you look at the stock market and it's just complete chaos? Yeah, you are definitely not alone. I mean, there are over 14,000 stocks out there to choose from. It's like being dropped in the middle of a massive ocean with no compass, no map. But what if I told you there is a map? A systematic framework that can turn all that noise into a clear signal. Well, in this explainer, that's exactly what we're going to do. We're going to build that map together. So here's our game plan. We're going to tackle this in 5 parts. First, we'll face that feeling of being overwhelmed head on. Then, we'll build our framework, one solid pillar at a time. We'll cover finding value, timing the market, and even generating cash flow. And then, at the end, we'll put all the pieces together into a strategy that you can actually use. All right, let's start at the beginning. The first step in any journey, right? It's knowing where you're starting from. And for a lot of people getting into investing, that starting point is just pure information overload. You hear tips from friends, you see scary headlines on the news, but it's all just noise if you don't have a system to filter it. And let's just put a number on this problem to see how huge it is. We're talking about more than 14,000 publicly traded stocks. Just think about that. Could you imagine trying to research every single one? You'd spend your entire life just reading reports and you'd never actually invest. It's absolutely impossible without a system, a framework to narrow things down. This quote right here really hits the nail on the head. See, information and knowledge are two totally different things. To make any sense of the market, you need a vocabulary first. You need a mental model, and that's precisely what this framework is all about. It's a way to take all that raw data and translate it into something that actually means something, so you can start making smart, educated moves. Okay, let's build our very first pillar, finding value. This is all about what we call fundamental analysis. But don't let the fancy term scare you. It really just means asking one simple question. Is this a good, solid company that's actually worth my money? This is our first and maybe most important filter to sift through those 14,000 choices and find real quality. And one of the most basic tools in the toolbox for this is the PE ratio. The easiest way to think about it is like this. If a company has a PE of 10, it just means you're paying $10 for every single dollar that company makes in profit each year. It's a really quick way to get a feel for whether a stock seems cheap or expensive. But it doesn't tell you the whole story. And that's where its cousin, the PEG ratio, comes into play. This one adds a super important piece of the puzzle. It asks, okay, that PE ratio is interesting, but how fast are the company's profits actually growing? Because, a company that's growing like a weed might totally be worth a higher PE. The PEG ratio helps us compare apples to apples. Let's make this really concrete. Take a look at this table. You've got Company A and Company B. Now, on the surface, they look identical, right? Both have a PE ratio of 10. But now look at the growth rate. Company B is growing its earnings at 20% a year. That's double Company A. And that, my friends, changes everything. It gives Company B a PEG ratio of just 0.5, which is incredible. So what's the bottom line? Company A is fine. It's fairly valued. But Company B, that's what the source material calls a killer value. So you've done your homework. You've used fundamentals to find a fantastic company at a great price. You're ready to pull the trigger, right? Well, hang on a second. Answering what to buy is only half the equation. Now we have to figure out when. And that brings us to our second pillar, timing the market. This is where we dive into technical analysis. Now hold on, this is not about gazing into a crystal ball and predicting the future. No way. It's about looking at charts to understand the trends, to understand the psychology of the market, so we can spot those moments of opportunity. And I get it, I totally do. If you're new to this, a stock chart can just look like a crazy, chaotic mess of squiggly lines. It can be really intimidating. Where do you even start? But just like with our first pillar, there's a system we can use to cut right through that noise and find a clear signal. The key is what's called the top-down method. Think of it like a funnel. We start at the very top, the big picture. We look at the whole market. Is the general tide rising or falling? Then we zoom in to find the strongest sectors, like maybe tech or healthcare. From there, we drill down even further to find the leading industries inside that sector. And only then, at the very end, do we pick one of the best companies. It's a logical process that helps make sure we're swimming with the current, not against it. This quote really says it all for this pillar. Arguing with the tape just means fighting what the price is actually doing on the screen. See, my opinion or your opinion about what a stock should be worth, it doesn't matter. The only thing that matters is what the market is actually doing. Technical analysis teaches us to follow the trend, respect the price, and trade what we see, not what we think. Okay, so let's recap. We've figured out our what and our when. We've found a great company, and it's in a strong uptrend. So what now? Do we just buy it and sit on our hands and wait? Or is there a more active way to profit from the assets we control? This is where we get to our third pillar, and this one is a real game changer: generating cash flow. This is all about turning your portfolio from just a passive collection of stocks into an active, income-producing machine. And we do that mostly by using stock options. Just look at the power of this. Let's say you want to get in on a stock that costs $120 a share. Strategy 1, you buy 100 shares. That's going to cost you $12,000 of your hard-earned cash. Or look at strategy 2. You could buy a long-term option that controls the exact same 100 shares, but it only costs you $800. Then you can immediately sell a short-term option against it and bam, collect $170 in cash right into your account. The difference in capital you have to put at risk is just staggering. 12 grand versus 800 bucks. So what does that look like as a return on your investment? Well, that $170 in cash you collected, that's a 21% return on your $800 investment in the first month. To get that same $170 by selling an option against the stock you owned, it would only be a 1.4% return on your $12,000. It's not even close. You're generating income with way, way less money on the line. And this is a total mind shift for most people. With strategies like this, you're not just making a bet on which way the stock is going to go. You are literally getting paid for the passage of time. Every single day that takes by, that short-term option you sold loses a tiny bit of value, and that value becomes your profit. It's almost like being a landlord and collecting rent on property you control. It's an incredible concept. Wow, we have covered a ton of ground, haven't we? We went from fundamentals to technicals to generating cash flow. But here's the most important part. These aren't just 3 separate little tricks. The real magic happens when you weave them all together into one single, powerful investing framework. And here it is. This is the map we set out to build at the beginning. It's so simple when you see it laid out. Pillar 1, fundamentals, tells you what to buy. Pillar 2, technicals, tells you when to buy it. And Pillar 3, cash flow, tells you how to get paid while you own it. And underpinning all of it is a 4th, implied pillar that's always there: risk management, protecting your capital every step of the way. Each part has its own crucial job to do. Look, at the end of the day, no system is perfect. You're gonna have trades that don't work out. It happens. But this quote from Rockefeller says it all, right? The difference between winners and losers isn't whether they lose. Everybody loses sometimes. It's how they react to it. A solid framework like this gives you a process, a way to manage your risk, learn from your mistakes, and turn what could be a disaster into a valuable opportunity. So we started this journey staring into the chaos of 14,000 stocks, and we're ending with a clear, simple 3-pillar framework to navigate it all. This isn't just theory anymore. This is a real system for making decisions. So the only question I have left for you is this: now that you have the framework, what are you going to build?